All right, traders, George here, and we just hit 2,000 in the cash S&P, first time ever. So I know a lot of you are thinking, what does that mean, and how can you trade that? So I'll show you what I'm looking at. We'll look at two different charts. One is we're going to look at the cash S&P chart. The other we'll look at this chart that you see right now, which is the balance beam model that I use for position trading the futures. Right now, the cash versus the futures is pretty darn close, less than 2 points away. So they're, for most practical purposes, they're pretty much spot on, especially for big picture work. Speaking of big picture, how about we go there first, and let's take a look at this. So this is the cash S&P going back decades. There's several key things to take away from this. For starters, a real important length of price or unit of price is from the 1987 crash low to the highs that we made in 2000 and in 2007. As a unit of one, that price, which is between 1336 and 1359 points off of the swing low from March 09, that projects up right about to where we are today. So that's a grand one-to-one move up. If you've watched my older videos, you know that I've been looking at this 1994 impulse for years as a projection tool to look for price to move into the 1800s. Once we broke through the lower 1800s, it really put this complete impulse on the table, and that's where we are right now. So whenever you see a grand one-to-one move, that's always a potential for a reversal at that point. Not necessarily having to be a complete trend reversal, but certainly a spot where you might see a very strong fade. And we're at that point right about now. There's also a lot of Fibonacci time confluence that comes into the zone where we are right now, based on all sorts of footholds, from highs and lows to highs to highs to highs to lows to lows. There's a lot of different ways you can slice a unit of one and make projections, and it just so happens that there's some real key stuff that fires off right about where we are right now. If you look at the RSI below here, we went oversold once back in the mid-70s, and it wasn't until the crash after 9/11 that we went oversold, and then it wasn't until March 09 that we went oversold again. These three technical occurrences actually happen to be real useful for projection tools as well, and I've used them to project forward and find confluence with this point in time where we are right now. Another thing is the highs that we made in 2000 and 2007. You'll notice here that we were actually hard overbought as we just got out of the gate here in the mid-90s, and we went up quite a bit more as we continued to put in lower highs on the RSI, even breaking below about the 65 barrier, and then even just about below 50 there, and continued to make lower highs as we made higher highs here for quite a ways. Also, another point to take note of is the round number of 1,000. We just hit the round number of 2,000, all right? When we hit the round number of 1,000, which came in the late 90s, we went up another 19% before we had a significant resistance swing. And we went up another 55% from that point before we really entered a bear market. So if the analogy holds true to this side, you know, as they say, do the math. That means that if 2,000 is not an issue because of the round number, well, the last time we hit 1,000, we went up 19%. Either way, it calls for higher prices from where we are now based on what happened at the 1,000 price point when we hit it for the first time. The other RSI point to look at here for tops is in 2007, and we were overbought a couple of times, and we finally broke down with some lower highs here. But as I like to say, we're not going to go lower until we start to go lower, which means you need to see the price proof of price moving down. And one of the big stumbling blocks for a lot of traders is they're always hoping that every move is going to be the last and they'll get in at the absolute top. If you drill down to a smaller time frame for either one of these tops, there are ample opportunities to see price breaking down more, and even opportunities once price really broke down doing an outside return to do more with your trading at that point. But you'll notice down here below 68 and below 62, the RSI on the monthly, I'm looking at 68 and 62 as two strengths of signal to the downside. We're at 79, 72s right now, so we got to break down a fair bit just to see those areas breached. That would indicate that we were likely going to pull back lower. We've done the grand one-to-one up. We've got a lot of fib confluence happening here, and the markets are actually responding pretty well. We've seen 1,000 and what that meant to us back here in the late 90s, the fact that we went up another 19% before we even pulled back, and we ultimately went up another 55% before entering a bear market. Could that happen right here? Well, I can show you some things to watch outside of this chart that will help you see that. So this is the balance beam model, as you probably know, and the balance beams, all the trading commitment. This is where all the big houses have done their trading, all the mom and pop traders. This is where a lion's share of the trading has been done, 1943 to 1955 and 1965 to 1975. And this is looking back over 120 days. So all the recent highs that we've made in the S&P, these balance beams really speak to a very strong commitment at these upper price points, and we're above it. You'll recall back in July I mentioned the price point of 1979 as sort of a trigger to watch for price to clear that, because very likely we would move higher if we did. We actually blipped up a couple points higher here and then came right back below, but here we are again taking that over, and we're up another 20 points from there. So that's price taking over the top line of all this trading commitment. And I had 2003 and 2034 as some extended targets here. I'm actually going to push this one up just a couple of points based on some new stuff that I was looking at, and I want this guy here at 2008. So I've got a 1-to-1 harmonic here that has some confluence with the 1618 from this prior drive up, and it's also got confluence with the 1.27 of the entire impulse up to the highs here, and it has some near confluence with the 1.27 inverse extension there. So there's a lot of stuff clicking in the 2004 to 2011 neighborhood, and I'm going to use that 1-to-1 harmonic to pull up that from the 3s up to the 8s there. We're essentially there right now, just a couple points higher. With this area here maybe forming a resistance swing and pulling back, anything that pulls back, you want to watch this area here for support. If that breaks down, then we go to this level. We're not going lower, we're not crashing until the bears can get price trading below 1943. Where we are right now, that's another 50 points lower, and certainly you'd have a little bit of a warning if we break below this area here. But bigger picture, we've got to go 50 points lower just to break below that, and that's a real good metric to watch for the time being until things change. That we're in a real strong bull market here. Buy all dips until further notice. I've been saying that for a long time. Nothing's changed. Buy all dips until further notice. Consider that the trend will continue until it doesn't. And the doesn't comes from things that we see, not from our gut, not from emotion, not from things that you hear, but from actual chart-driven data, pure price, that orange rectangle, the ultimate in truth there, pure price. So we're not going lower, we're not crashing until we start trading below and closing below 1943, and that puts us below this entire dense trading zone here that's all happened in the last 120 days. Price is above that, which is extremely bullish, and if that changes, that would be a red flag for the potential movement lower. We did see a break below here, but we recovered, looked at going long there, and the rest is history. Now reset in terms of defense, watching for price to break back below those areas. So just a little higher to 208s. The next spot above that, 2034s, is what I'm looking for. If we start to chop up around this area, maybe we pull back, we break below here a little bit, recover, we could go sideways for quite a while here. This is a zone that you want to respect with price breaking back above or breaking below in the future. So if it starts to chop up, maybe it trades down to 1930. If it reclaims 1945s, very likely going to start to fill back up to the top of the channel here. If we pull back and find a support bounce here at 1970s, 75s, very good chance that we're going to bounce up and retest where we came from. If we break below here, drive lower and pull up and put in a resistance swing, very likely going to make new structure lows. So all of that will be something that we look at in the live room ongoing. But last thing I'll mention is the time confluence from the S&P cash chart that I showed you. Often I look to something like this confluence of all these things happening here as a point to assist price to do something different. Usually when you're in a bull trend, that something different is to put in a resistance swing and go back down. Well, the other option for something to happen relative to Fibonacci confluence of time, and when you hit one of these zones, if it doesn't fade, the other catalytic option or choice would be for the traders to actually accelerate the move up. And that's another thing that we could be seeing, is price actually moving up quicker than it has just recently. And don't be surprised if you see that happen. So there's my look at the S&P with a lot of neat historical data there, a lot of Fibonacci ratios for time and price, really clicking all over the place. And then the more near-term bounce beam view there, showing you a real powerful and strong position there for price to remain over these recent balance beam commitments. Really incredible chart there. We'll keep on top of this in the live room, and I'll see you back there.